So we are going to start our next question. FROSTE company has a dividend payout ratio of 40%. Dividend payout ratio of 40% means out of 100% they are paying 40% dividend and 60% is the retained earnings. And has maintained this payout ratio for several years. Current dividend per share of the company is 50 cents per share, and it expects that its next dividend per share payable in 1 year time will be 52 cents per year. So the next year it will be 52 cents. Ordinary shares $1 par value, total value is 25 million. Bond A and bond B, $100 are the par values, and total values are 20 million and 10 million.
Hey, boy, how
Bond A will be redeemed at nominal value in 10 years and pays annual interest of 9%. The cost of debt of this bond is 9.83%, which means IRR. The current X interest market price of the bond is 95.08. So already market price is given and IRR is also provided. Bond B is redeemable in nominal at nominal value in 4 years time and pays annual interest rate of 8%. Cost of debt is 7.82% and the current price is 102.01. Cost of equity is 12.4%. Calculate the values of the FROSTE company ex-dividend share price using dividend growth model. So the dividend growth model says what? Dividend growth model says recent dividend into 1 plus growth rate. Growth rate is not provided. But we are provided with what? We are provided with the retention rate, which is 60%. And we can calculate growth rate if needed. Although next year's dividend is also provided in the question, so which is 52 cents, and cost of equity is also provided. So what will we do? We can use this 50 cents or along with the growth rate to calculate next year dividend, or we can use directly the next year's dividend. Now the next question is, it is multiplied with what? Retention rate is multiplied with return on equity. And do we have the return on equity in this question? Are we provided? We are provided the value of the equity, but we are not provided with the return on equity. So what to do? We have to calculate the growth rate by using the dividend between the 2 years. So growth rate percentage is equal to $0.52 we will pay next year divided by 0.50 into 100. So 0.52 divided by 0.5, it is 104%, or we can simply say 4% growth rate. Now we will calculate share price. Share price is equal to recent dividend 0.5 into 1.04 growth rate divided by cost of equity minus growth rate. $6.19 is the share price. This is the answer of first question. Second one is capital gearing, debt divided by debt plus equity using the market values. So for market values, we need number of shares. 25 divided by 1, 25 million shares. 25 divided by 1, 25 million shares multiplied by share price, which is 6.19. It is market value of equity. There are two debts. One is bond A, second one is B. And for bond A, par value is 100, and this one is 20 million total value, and second one is 10 million. So 20 million divided by 100. So we can say that 200,000, and here 10 million divided by 100, 100,000, multiplied with what? Market values, which are 95.08, and here 102.01. So 200,000 into 95.08, 19 million. So add the value of that. Now capital gearing is equal to debt and what is the value of equity? 25 into 0.6.19, 154 million 750,000. So 154 750,000 into 100, 29217 divided by 29217 plus 154 750. 15.89% or rounded to 15.9%. This is the capital gearing. Third one is market value weighted average cost of capital. Now we have market values and we are provided with the cost of equity and cost of debt, everything. We can do what? We can convert these market values into proportions first. In percentage terms, equity has a market value of 154 750,000. I'm ignoring 0. Bond A has a market value of 19,016,000. Bond B is 10,201,000. 154 750 plus 19,016, 10,201. It is 84%, or we can say that 84.11%. 84.11%. Next one is 19,016 divided by 183,967, 10.33%. Third one is 10,201 divided by 183,967. It is 5.54%. WACC is equal to proportion of equity into cost of equity. I think it is 12.4%. Plus proportion of debt into cost of debt. Cost of debt is 9.83, and it must be after tax. We are ignoring taxation, otherwise we will deduct 1 minus tax. So for bond A, proportion is 0.1033 into 0.0983 plus bond B 0.0782. So now 0.0782. It is 0.004336. 0.8411, 0.124, so 0.10429 plus 0.1033 into 0.089, 983 plus 0.10429 plus 0.004336. So the answer is 11.87%. This is the weighted average cost of capital. Any question? Next part is discuss whether change in dividend policy will affect the share price of FROSTE. Yes, change in dividend policy always affect the share price of the company, because there are different types of shareholders in the company. A few shareholders are dividend relevant and a few are not dividend relevant. So those who are dividend relevant, they always expect from the company that company will increase dividend by a certain percentage every year, or company will continue to maintain their dividend payout ratio. So if company will not continue to maintain their dividend payout ratio, or company will not increase the dividend, it will give negative signal to shareholders, and they will expect that, or they will assume that company is facing cash flow problems. That's why company is not able to increase the dividend. So this is called what? This is called dividend relevancy theory, that these shareholders are the dividend relevant. It includes what? It includes those individuals who have no additional income now apart from the dividend from the share investment, or they need some additional income to fulfill their day-to-day expenses. And the other type of shareholders are institutional investors. They also have investments from their depositors, like they have investment from the pension trust, they have investment from the individuals, those who invested in the unit trust, those who invested in the mutual funds, and they expect that company will pay a dividend and then they will be able to increase their payout ratio towards their shareholders. If company will not pay dividend, or if company will reduce the dividend, or company will not grow dividend by the normal growth rate, it will give negative signals to them and they will be unhappy with this decision of the company, because they will not be able to transfer this benefit to their shareholders or to their unit holders or investors or depositors. On the other hand, there are a few shareholders who are not relevant with the dividend, or they are unaffected. Either company continue to pay or increase the dividend, or company reduces the dividend. And they are called private wealthy individuals. Individuals who have different sources of income, so they are not interested to withdraw dividend every year. In fact, they want capital gain and they want to avoid tax on the dividend every year. So they will be okay if company is changing their dividend policy and company is planning to pay significant amount of dividend at some future date. So they are called what, dividend irrelevant. They will not get any negative signal about the company's cash flow position, or they will not assume that company is facing any cash flow crisis, because they are not interested to get dividend every year. Now it is expected from the company to make a balance between the dividend relevant shareholders and irrelevant shareholders, and try to satisfy the needs of the both type of shareholders, especially those who are interested to receive dividend every year. Next one is explain why FROSTE companies capital instrument have different levels of risk and returns because of their level of investment, or we can say that because of their level of security. For example, shareholders are the one who are the owners of the company. That's why they are less secured, and whenever there will be any bankruptcy, they will receive their shares at the end. And no asset is provided to give them any kind of backup in case of bankruptcy. This is, I think, discussed we earlier or in the last class as well. So, but they will get the highest return as well. You can see that cost of equity is 12.4%, which is greater than the cost of debt. Second one is what second one is bond A. Bond A is receiving high cost of capital, or bond A is receiving higher cost of debt or effective interest in comparison with the bond B. So we can assume that bond A is more riskier than the bond B. That's why you can see that its market value is lower than what its market value is lower than the bond B's market value. Its effective rate of interest is greater than its normal coupon rate. On the other hand, second bond has a higher market value because its effective interest is less than the coupon rate. What does it mean? It means if a company has higher coupon rate in comparison with the effective interest rate or market interest rate, it means they are attracting more investors there, and their share price will be, or now their bond price will be higher. But on the other hand, if a company is offering lower discount rate as compared or lower coupon rate as compared to the effective interest rate, its market value will fall down because company is not offering the uh, equivalent to market interest or market IRR. So this is the risk and return. And bond B, those who wants to take higher risk, they will invest in the bond B, and they are ready to pay the higher market price in comparison with the nominal value, which is $100. But they will interest higher coupon as well. Those who wants to take lower risk, they would have to pay lesser market value as compared to nominal value for the bond A, but they would have to settle themselves with the lowest possible interest rate of 9% with 10 years maturity. So this is called what? This is called risk and return relationship. Simply we can say that higher the risk, higher will be the return. Right? Anyone? Any question?